This is LONGWave, featuring technical analysis and market analytics by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on his analysis, which he feels to be accurate and unbiased. Participants may or may not hold positions in any securities that are discussed. You should always consult a registered investment advisor before making any investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Thursday, April the 4th, 2013. I'm Gord Long at GordonTLong.com. As usual, I have a lot of charts for us to go through this morning, so therefore I'll pass over some of them quickly, but leave you to examine them further at your leisure. You'll need to open your slide viewer to full screen viewing, or you'll not be able to see some of the detail I'll be showing here this morning. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analysis and technical report. This is based on our quarterly cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscribers report so as not to confuse them with the drivers that are acting behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term risk, and in the short term confidence and sentiment. In this regard, I want to talk today about first the elevated levels of risk, second how confidence has fallen as we predicted, the dangerous combination of uncertainty and complacency which we discussed previously still rules. As a consequence, we are near the oh shit moment we have been warning. This is when the central bank's actions begin to be questioned. As has already happened in Japan, it will force the central banks to become even more aggressive at that point, and we'll move from monetary malpractice to what I'll refer to as monetary madness. Third, the ever-increasing risk that we see within all the global economic indicators that we follow. I want to show some of those. And fourth, the fundamentals and how earnings have clearly peaked for this cycle, and how negative the quietly released Q1 earnings pre-announcements have been so far. I want to start with risk and a technical chart. This is an updated technical chart using Fibonacci ellipses and spirals, which we put out in January. It was initially released as Beware the Ides of March, then again in February as Redux, Beware the Ides of March. It has turned out extremely accurate, and we now expect some volatility as we finish our long discussed right shoulder formation. It is likely that nothing significant will happen until after the April 15th tax deadlines, when all that IRA and RSP money has been collected. Give the deposits a week or two to be placed as the Q1 earnings conference calls are unfolding. We should see some significant volatility increases during that period and after. The head and shoulders chart we've been showing for a long time has unfolded as we predicted. 2 years ago, we debated whether we would see a right shoulder as part of a rounded top or a megaphone top. The back issues of the MATA report show the megaphone analysis that we outlined, and I encourage you to revisit it because it appears we may get the megaphone, which means that right shoulder will be a little higher than the head. There is a good chance this is actually what the final pattern will be. Clearly, we're seeing a new high in some of the indices. What is important, however, is that we are at a critical point where we soon expect to have the Q2 market scare that we have been calling for. The scare will be responded to by the central bankers with OMF, overt monetary financing, which we see to be in late Q3. The market will then retest these highs we are putting in as part of, I believe, will be a wave 1-2 of the beginning of the long-anticipated resumption of the bear market. This month's MATA report document lays this out in much more detail. Let's talk about risk. I have shown the delusional divergences in prior sessions, but I thought this morning we would look at 3 new ones that are relatively rare, which in itself is telling. The first gives us a view of what I will refer to as economic risk. This Bloomberg chart, and I apologize for the black background, shows the S&P 500 versus initial jobs claims. Business Insider calls it the best market indicator that they've ever seen and use it regularly, and I have shown it for years. We have a significant divergence. The jobs market is not improving at the rate of the market advance, and the separation is growing. The next chart is what I refer to as a view of higher quality risk. The chart shows that the Bank of America Merrill Lynch Global Financial Stress Index versus the S&P 500. The Global Financial Stress Index attempts to measure stress in areas such as solvency and liquidity, price momentum, and short-term volatility. This is the first time it has broken significantly below equities in over 2 years. The next chart is what I refer to as a view of lower quality risk. The chart shows the S&P 500 versus the Marquette CDX North American High Yield Index, which tracks credit default swaps for 100 non-investment grade debt issuers. This has demonstrated an extremely tight relationship. It has recently quickly and abruptly separated. One of the charts you might view as a concern, but all three together suggest something much more dangerous is occurring here. This chart from the AAII, or the American Association of Individual Investors, sheds some light on the market headlines that cash allocations have reached a 16-month high in March, and therefore this is a bullish sign that cash will be put to work. Equity allocations fell 3 percentage points to 59.5% in March. The past 15 months have not seen much variation in equity allocations, stuck in a range from 58.8, that is in June 2012, to 62.5% in February of this year. The historical average is 60%. I read this that small investors just don't trust the market at these levels and are lightening up. When something comes along that frightens them, you can expect the reaction to be more violent, especially based on what they have experienced over the last decade. They're extremely nervous and extremely cautious. This sell-side consensus chart going back nearly 30 years shows us that since the dot-com bubble burst, sentiment has continuously worsened. It also shows that the reaction has become more intense as the slopes of the lines have become steeper. We are now at all-time lows, which on the surface would suggest that from a contrarian standpoint, markets should begin a multi-year advancement with steadily improving sentiment. I don't believe this is what the charts are telling us. I think it is telling us that investors don't see market upside potential. Typically, in a normal cyclical environment, this is a contrarian reading and is therefore time to enter. This time I believe it reflects that the stock market no longer is indicative of the realities of Main Street and has been steadily separating itself over at least the last decade. Presently, the markets are being artificially held up by the $85 billion per month of new money printing, and that's priced in, or nearly priced in. Small investors are out of the market. Professionals and speculators who have to live off the market are fully invested. They have little choice. They can't leave money on the sidelines. All of this has the ingredients of dry tinder waiting for a spark to set things off. What could set it off? Many things. I list those in this month's Matter report in the risk area under 2 different reports, 10 things that could wreck the bull market, and a separate list of I see 10 signs that show the stock market is overbought. Those are 20 different line items that you might want to go through. Let's look at 6 economic charts that are worth revisiting. It would appear that between the historical revisions of over-optimistic initial prints in macro data in the last few months and the reality of weakness in Europe, the global economy is in a slowdown. Goldman's swirlogram has now seen its global leading indicator in the slowdown phase for 2 months as momentum fades rapidly, and 7 of the 10 major factors in the index declining, with global aggregate PMI and global new orders less inventory worsening. Quite Comically, the three factors providing some positivity are the Baltic Dry Index, which we are told is irrelevant when it drops, the Japanese inventories to sales, which improve but remains at depression-era levels, and U.S. initial jobless claims, which have become a farce statistically as far as I can tell. Of course, none of this macro reality matters for now, until it does, that is. The red arrows show the relative size of adjustments from the initial estimates. You are no doubt well aware that many of the EU countries are now in a recession. I think what needs to be appreciated is how bad this is becoming even from a historical perspective, and the rate at which this deterioration has occurred. Europe is a top concern, with most companies agreeing that a turnaround in 2013 is not in the cards. Bloomberg's just released Orange Book of earnings conference calls indicates that European executives see no signs of recovery. What I see in Europe and the UK suggests it is going to get even worse, and that this is a structural issue that is long term. The EU approximates 25% of the global economy. You can't have this level of deterioration and not take the rest of the world with you. Minimally a significant slowdown, and how that would be reflected in earnings. I've been writing about the EU and the European experiment since 2009 specifically, and what is unfolding now has been well telegraphed for a long time and should come as no surprise to longer-term subscribers. Recently, we have witnessed the biggest drop in U.S. macro data in 9 months. This is alarming, but exactly what we wrote about in February in our research note, Trouble Coming to Paradise. These charts are some of the charts from that report that show how cyclical the global macro has become since the central banks have become coordinated in their balance sheet expansions. It signaled we should expect deterioration to become evident by April, and here we are, and that is what we just saw in the previous chart. Don't look to the U.S. for help, and don't believe the sell-side CNBC media hype. The U.S. is a 70% consumption economy. It simply can't improve or maintain its current levels when median household incomes are shrinking at these rates. With 20% of the population on food stamps, with the U6 unemployment rate approximating 14%, and over 120 million Americans dependent on government transfers of one sort or another, the U.S. is simply stalled and won't be able to recover without a market-clearing event, which I recently discussed in 2 macro-analytic videos with my co-host Charles Hugh Smith. The mispricing and malinvestment must be cleared to allow capitalism to work and investment to reignite growth. The ratio of negative to positive earnings guidance, which stands at a record high, should worry investors, but as yet it hasn't. As the first quarter drew to a close, 86 companies in the S&P issued negative guidance for what they expect to report in earnings for that period. Just 24 issued positive guidance. At 3.58 negative updates for every positive one, that is by far the highest ratio since FactSet began tracking such data in 2006. In the last bull market, the negative corporate guidance ratio hit a peak of 2.38 in the third quarter of 2007, just as that bull market was ending, and troughed at 0.97 right as the bottom was in stocks in Q1 2009. A look at consensus earnings per share expectations for the companies with the 10 highest weightings in the S&P 500, making up close to a fifth of the total, shows a similar pattern. Relative to where forecasts stood at the start of the year, they have fallen for 7 and risen for 3. There may be a nasty drop coming on the other side of this wall. That's what this is telling me. For all those calling for a multiple expansion to save us from all this dismal earnings, take a look at this. CAPE, or Shiller's PE, says we are near a peak unless even more labor costs can be pulled out of operating expenses. How much more can we pull out? And I'll show you a chart here in a second. The earnings expectations suggest analysts see something coming that borders on, in my estimation, nothing short of a miracle. Of course, these are always taken down, always. If we have any sort of correction, watch out how quickly and quietly the analysts will then immediately take down the earnings during all of the, I'll call it, confusion and attention in other areas. Beware of an earnings trap and beware of an earnings recession. I like this chart from Lance Roberts at Street Talk Live. The chart shows while earnings per share has risen by over 200% since the beginning of 2009, revenues have only grown less than 10%. 200% versus 10%. Since the economy is 70% driven by personal consumption, GDP growth and revenues have grown at roughly equivalent rates. Therefore, the question, where is this corporate profitability coming from? What's the answer? Well, the answer is, as can be clearly seen here in this chart, corporate profits per worker is at the highest level in history. How much more labor can we cut, move offshore, or benefits slashed? Likely some more, but that is a monumental hockey stick we just looked at here in the prior charts. Year to date through March 31st, the few winners have been so far the Nikkei in both Japanese and U.S. terms and the U.S. S&P, period. The U.S. is printing $85 billion per month, and Japan is going to be going at a rate of about $75 billion per month, and being one-third the size of GDP. In my estimation, is now priced into the stocks or very nearly priced in. So let's recap. We expect a Q2 market scare, and it is near. We are presently putting in a major, long-term, what we can refer to as the right shoulder. This may not end up being a head and shoulders rounded top from an S&P perspective, but rather the megaphone top we originally thought of to be an alternative. It strongly suggests that. So prices could top a little higher than the levels we are currently at. We show these in much more detail in the Matter Research Report document. The gold charts give us a strong clue of what we may be ahead, and I encourage you to read what OMF means to gold, which is posted on our site. In closing, I'd like to take a moment as a reminder. Do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, I hope that 2013 will be an outstanding investment year for you. Do your homework. Talk to you later.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.